They don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hey guys, welcome to the Real Estate Jam podcast. I'm JD with my wonderful co-host.
Me. Hey, how are you?
Melissa. And we've had a pretty busy week, so I'm glad that we got to squeeze this one in.
I'm so excited.
Super excited. We got a good show for you guys today. I don't think we've ever had anyone that has quite this expertise on the show. And so I'm super pleased to introduce you guys to Martin Saenz. He's managing Bequest Funds. He's a hedge fund manager. He is a accomplished author, real estate buy and hold investor, and small business entrepreneur. Martin, thanks for coming on today, man. I'm really glad you were able to find time to meet with us. Thank you.
Yeah, my pleasure. Yeah, thanks for having me on, JD.
Yeah, no worries. Hey, I'm hoping that you can maybe introduce yourself to our audience, explain to them, one, why they should pay attention to you, and kind of give them a rundown of how you got started and where you're at now. Sure.
So why they may want to listen is I say this with humility, but I'm financially free. So if I didn't do another active investment for the rest of my life, I'd be fine. And so, but it wasn't always like that. So my wife and I, we've been at it as entrepreneurs since 2004. We launched our first business in 2005. And so there was many years where we were kind of building something and something from not having much. And so just the fact that, I have experience kind of doing things the wrong way and doing things the right way and eventually turning the corner, that might be of benefit to someone. But we did small business ownership since 2005. We ran a government contracting company. We later sold in 2013 at the height of its performance. And we've been buy and hold real estate investors since 2009. I'd be happy to share our experience of the first property that we purchased.
Yeah, no, I think that's really great if we could kind of go into that. And then I'm sure Melissa and I will have a ton of questions for you because we're always trying to learn too.
So I don't believe this is going to work today, but if it did, I'd be more than happy to do this practice. Okay. So it was 2009 and my wife and I, we were working out of our home. We had all this equipment and we had employees. They would come over to the house on a daily basis. And we decided that we needed to move into a business location. So I went on Craigslist and I looked up different real estate properties. And there so happened to be a commercial building for sale in our town that we lived in, which is Northern Virginia, which, it's a pretty populated area. And so I met with the person selling the property and it was I think it was for sale at like $320,000, something like that. And I met with him at Starbucks with my wife there. And I said, we're going to give you $300,000. We'd like to offer you $300,000, offer you 10% down, and you can take back a note for 15 years at 6% interest for the remaining portion. And I'll never forget this because my wife reminds me of this. He about jumped out of his chair with excitement. And so, me, that's a hit on my negotiation abilities. But I know the feeling. Yeah. So my wife brings that up, opportune times. But yeah, so we ended up moving our business to this small building. And literally a month later, we bought an adjoining building from the same owner with a seller take back note. And we ended up buying, I think, about 5 properties through that same Craigslist system. I don't know that would work today.
Mhm.
But we also bought buildings through some brokers and MLS and that kind of thing.
Yeah.
But that was our
Craigslist
first
is
experience.
definitely saturated today. I mean, you really can't get on there without some professional or seller being right there in your face. That's for sure.
The ship has sailed.
I do like the owner finance, the seller carryback. We still work on a lot of those. It's a lot better than having to go through the bank process. You get to negotiate your interest rate. You get to negotiate down payments. Those are all huge and really big steps. Do you still own that building, or did you guys get rid of it? Or
So I'm about 2 years from owning it free and clear, and both buildings, and so I'm looking to sell those with seller financing.
Awesome. Have you looked up what you think they've appreciated to since, or what you forced the appreciation to since you've owned it?
Yeah, not much. I mean, I'd say it went from about 300 to about 380. And so not much given the period of time. It's in kind of a rougher area, but they're industrial spaces. And so I guess we'll find out what the market has to bear, but it'll be a cash flow stream. So that's positive.
Awesome.
Yeah,
so you start with your first commercial space, and then the very next day you start managing your hedge fund. Is that right?
Yeah. So we operated the company out of that space, and then when we sold the business without the real estate involved. So they took back they occupied the space as a tenant of ours for many years. So that was kind of cool. And actually, the funny story is, we bought another commercial building down the street that was bigger in 2016, 17. And then they moved to that space and paid us even more money monthly as well. And when we were at that other space, I hooked up with the developer who owned a bunch of the spaces, and he sold me another space with seller financing. So we've done the seller financing thing pretty well. And yeah, I'm a real strong proponent of that. But when we sold the company in 2013, I was at a RIA event, local real estate club in the DC area, because we were living there at the time. And I ran across a mortgage note investor. And from there, I read every book I could find on it, took a 3-day class, and bought 10 mortgage notes out of the gate after like 2-month period.
Okay. And those mortgage notes, are you buying performing notes, non-performing notes? What does it look like your first ones?
Okay, but I have to stop you guys, because you guys are super smart and you're talking over everybody's level here. So you have to break down what is a performing versus a non-performing. Okay.
Yeah, I'd be happy to. Yeah, thank you for that. And I apologize for that. It's like, well, this is what I do on a daily. We buy bank originated mortgages, both in performing and non-performing states. So what that means is you have someone that wants to buy a home, and they go to a bank and they apply for a mortgage, and a mortgage gets approved. They go to the closing table and they sign a promissory note, which means they're going to borrow money and they promise to pay it back given a certain set of terms. And they also sign a deed of trust or a mortgage document, which ties that promise to the property in the form of collateral. So in case they stop paying, the bank can go take back the collateral, which is the property. Now, in about 4% of the cases, the homeowner stops making payments at some point because they run into a situation. They get divorced, or there's a health issue, they lose their job. And so after a few years, the banks, some of the banks, they'll bundle those into pools of defaulted mortgages, and they'll sell them into the secondary mortgage market at 20, 30, 40 cents on the dollar. Now, mind you, these are mortgages whereby the homeowner hasn't made a payment in 2, 3, 4, 5 years. And so they're in massive default. So our hedge fund in I launched in 2013, and we've been buying those mortgages from larger institutions and other hedge funds. And we, in a very compassionate way, connect with the homeowner and help them get back on their feet with a loan modification. And so what that means is that because we purchase these mortgages at a discount, we're able to make certain concessions to help bring them back on their feet. You know, mind you, it's been a few years, so they maybe got remarried, they got their health back, their job back, and they're in a better situation. Now, also keep in mind that they were in a good situation when they got the mortgage to begin with. They just had a hiccup in their life that we all can relate to. And so we look at their financial situation. They may not be able to afford $600 a month, which is their monthly loan payment, but they could do $450. And we plug it into our internal rate of return calculations. We make sure what can fly. And if we can meet the homeowner in the middle, you know, all the better for everyone involved. And that's really what our main focus is to help the homeowner remain in their home with a payment plan they can afford while making a profit for our company. And that's our mission statement. Now, through the course of time, hedge funds like ours and others in this space have accumulated a portfolio of these performing mortgages that are loan modified, and they're paying 12 months of seasoning, 24 months of seasoning. So my partner and I launched an income fund early last year, about 18 months ago, and that only buys seasoned performing mortgages from the secondary mortgage market space for 12, 13% yield. And we buy them into our fund, and then we pay out our investors at a 9% annual return, by which we pay out on a monthly basis. That's a mouthful, isn't it?
Yeah, that's a lot.
There's a bunch of people that had a loan to buy a house at one time. They stop paying those loans, and then your first company comes in and after a certain amount of time and buys those loans from the on the secondary mortgage market, right?
Mm-hmm.
Essentially from the banks. And then you guys have a team of people or something that reaches out to the homeowners, tries to make contact with the homeowners to modify their loan, because ideally you want them to go from non-performing notes to performing notes. And once you've got them into the performing status, you're able to sell those notes off to your secondary business, which you're funding with private money partners, other investors. I assume that they are accredited investors that are coming into your fund, right? So sophisticated or accredited investors are loaning your company money to buy those loans with the expectation of getting a stabilized return back out of it. Is that?
Yes. Other than the people that invest in BQuest are equity stakeholders. So they own a part of the company.
Gotcha.
And so they receive the benefit of ownership in the case of liquidation and everything else. They're preferred investors. So they're first in line to receive payment before the fund operators, that myself and my partner. And however, they get paid out like a debt structure. If you put in 100,000, you'll get 9,000 per year divided by 12. And that money will be ACH'd into your account at the beginning of each month. And that's kind of how it works. So it's a good hedge against inflation.
So talk about, because you guys are still doing it.
Sorry.
Talk about accredited versus non, and then the preferred. Y'all briefly said that about what the preferred was, but the accredited.
Yeah. So an accredited investor is an individual who has a net worth of $1 million or more, excluding their equity in their primary residence, or it's an individual that earns $200,000 or more per year, or it's a joint couple that earns $300,000 or more per year. So then if you fall into that category, then you're considered an accredited investor, and you can invest in BQuest funds. And it's a good way because you may have some listeners that are exploring entrepreneurship, exploring house flipping, landlording, but then they decide at the end of the day that it's just too much work. And you guys understand how much work is involved in all those aspects. And so they just want to park their money in something that they feel is going to provide them a return. And they're already accredited. So that's great. But if they want to take the entrepreneurial journey, especially on the note side, they can read any one of my books, my first one being Note Investing Made Easier. I always give props to, people willing to take that plunge. But at the end of the day, one needs to look at how much active income they need to earn or they're currently earning versus how much they're passively earning. And the goal in life, in my opinion, should be to have your passive income up here and your active income down here at the point at which you want to retire.
Absolutely. I think well, at least everyone that listens to our podcast and all of our network, that's the whole goal. And that way you can choose whether or not you want to work actively. And that's really what it's all about, is time freedom and choice and I guess money freedom and choice. I do want to go back real quick. So we talked about what happens to the performing notes or the notes that you get back into performing status through the hedge fund. You guys are selling those off, or I'm sure you're keeping some of them for a certain period of time, the season period and all that. But what about the ones that your team reaches out to and they've either left the property or it is going to stay in a non-performing status? What are you guys doing with those? Are you selling those back off into to other investors? Are you foreclosing on the properties? What is your strategy for the non-performing or the ones that you don't think are going to be able to be moved into a performing status?
Sure. So we say we have a saying at our company: the buck stops here. We keep our notes to fruition. And so what that means is if we modify a mortgage on the hedge fund side and we get it to move from a non-performing to a performing state, then we're going to hold on to that cash flow stream in the hedge fund because the hedge fund pays for the operation of the company. And if we're unable to come up with terms with the homeowner, then we'll pursue foreclosure if we have to. But here's the rub. You could have there's many hedge funds out there that will operate similar business model. However, they're more heavy on the foreclosure side and they're less heavy on the compassion side. So they tend to foreclose about 20%, 30% of the time on their portfolio. We foreclose 1% of the time on our distressed fund portfolio. So what that tells you is that we have a team of 14 individuals that are fully focused, myself and my partner included, on connecting with the homeowner and really building a relationship, treating them like gold, because we view them as customers that are going to be paying our company as a customer would pay any business. And so we feel like based on those relationships we build, as well as the due diligence that we put into buying these assets before we purchase them, we're able to vet, we're able to do a property analysis to understand the collateral we're working with, equity coverage to make sure we're covered, as well as we do a deep dive into the borrower and their situation, credit report analysis, title report analysis, PACER background checks for bankruptcy, skip tracing. So we do a whole host of due diligence analysis that any lending institution will do. So heavy emphasis on what we buy before we buy it, but also heavy compassion on the workout side as well.
So
super cool.
When you're looking at buying these, are you buying them in tapes? You're buying big packages and you're going through and you're evaluating each one and you say, 95% of these fit our criteria, 5 don't, so we'll buy it and take it on? Or are you buying them on individual property basis? What does that look like? Because when you're talking about doing all of that due diligence and you're buying a package of 100 properties, that can be pretty labor intensive to find out that you're not going to want to take that onto your portfolio.
Yeah, so we're currently buying a pool of 17 mortgages right now. Our last buy was 394 mortgages. So we'll buy in pools, and generally it's going to be an all or nothing takedown. You have to price adjust if you have some loans that are on the shady side. But the objective is to keep good relationships with the sellers. And so you do have to bend and have some flexibility. They know you're going to do well with the home runs. So you have to respect, taking off the duds from their plate on the other side too. So it's a real balancing act.
Sure.
And so you guys are also, you're raising money for bequest funds, but you're also raising money to purchase the mortgages in the hedge fund. Is that right?
No, we're actually, the hedge fund is privately owned between myself and my partner in full. So we actually don't have any investors in that fund.
Okay, so that's just your guys' money. So you're the buck really does stop here.
Yeah. We have no one to answer to, but ourselves and the homeowners that we support.
Mm-hmm. So what took you from where you were at to doing the hedge fund thing? I think being a real estate investor and then jumping to mortgage notes, it's not that big of a jump, but it's definitely a different strategy and a different path. Mm-hmm. And it doesn't sound like that was what your goal was when you're starting out. So what led you to that?
Yeah, it was a whole unlearning experience, actually. So as much of it is the opposite side of the same coin, in many respects, it's not. There is, small business ownership taught me about 100-hour work weeks and meeting payroll and, scaling a business as best you can with what you know. And, but, it's very taxing time-wise, anxiety-wise. And then buy and hold taught me that I'm not going to scale the way I needed to scale from a cash flow perspective. I mean, it's a great annuity play as I'm having properties now that are starting to pay off in full. Mm-hmm. And so, but on the mortgage note side, you're buying, it's a little bit more sophisticated in my opinion, because there's more nuances and pitfalls. There's a whole element of compliance. There's a whole element of having certain licenses in place in various states, because we're operating nationwide. So you need to have resources in place and systems in place, and you need to go down the road of complying with all the rules and regulations, or you could get caught, really badly, really badly, financially as well as everything else. So I had to unlearn. I thought I came in, having a real estate background, that I was just going to be trailblazing in the note space. That's not the case. I mean, think about this. We only take back the property 1% of the time. So my real estate hat only really benefits me 1% of the time. Right. The other 99% deals with all these complexities of compliance and building due diligence processes and analysis work and all these CRM and dialer systems and all these systems in place from an asset management perspective.
That's
a lot.
It is a lot. I mean, it does sound a little bit more sophisticated than a lot of the regular investing. I'm wondering, out of what is your percentage, I guess, of your buy rate? And what I mean is, out of, if you're looking at 100 properties or 100 mm-hmm. notes, of those 100 notes, typically that you guys evaluate on a weekly, monthly, daily basis, how many are you actually choosing to bring into your portfolio?
So how it works with us is a little bit different. A majority of our trades are negotiated trades with long-standing relationships between us and other hedge fund operators. So they may, we're dealing with some hedge funds. I mean, we're only a $35 million hedge fund on the distress side. We're, $50 million income fund on the other side. So we could be dealing with, we do deal, not we could be, we deal with hedge funds that are 500 million, 750 million on up. And so they may take down $100 million trade, and then they may have 5 million that is outside their buy box outside their buy box. So they'll sell it off to us as a negotiated trade. So that's how most of our trades go. So we actually don't have a lot of pick and choose. We're not in the open market with what we do. It's very much what they call in our industry is a shadow industry.
Okay.
So that's where most of the operating goes, or most of the deal flow trading goes.
Okay. Do you think that note investing and taking on this strategy is something that the average real estate investor could get into and understand and learn? Is it something that there's blueprints that you can follow? I mean, obviously mm-hmm. you've written a couple of books, so you're writing a blueprint, right, for these guys to, note investing is a viable strategy that we know that there's a lot of high level people that are doing it. But do you think can a regular kid come up and learn how to do what you're doing and build it to that level? Or is this something that's more reaching for the stars?
Yeah. So, I was a C student from kindergarten to to high school. And, my father always told me, his dream or like he gets to wash his hands after I graduate high school because I lived. Like that was his goal for me, is like just to live and not kill myself. So, so as far as like big aspirations or like where you have to be or rocket science or something like that, now I went on and got studious and, I went and got an MBA and all that. But no, I'm definitely, I'm low on technology. I'm good with a calculator. And that's about as far as I go from technology standpoint. So this sky's the limit. I mean, for someone who's ambitious, someone who wants to put in the work. My books are, I used to mentor a few people on a selective level. I don't mentor anyone anymore. So I really don't have anything I'm looking to sell you, to be honest with you. Pick up my books, Note Investing Made Easier, Note Investing Fundamentals are a few. And then learn this business, learn as much as you can, and you can try it out yourself. Now, I will say that it's harder on the mom and pop level than it used to be. And that's probably the same on the flipping side too, I would imagine. In 2013, when I started, I mean, there was notes falling from the sky. I mean, you could go pick up every which way. And now it's like, it's tough. Inventory's tough for the mom and pop. Very, very, a lot less deal flow trickles downstream.
How do you expect the forbearance situation to apply to note investing? And what are you guys looking out for? Is that something that you have your radar up for?
Yeah. So last I saw with the U.S. delinquency rate in the country is like 2.5, something like that. So it's decreasing. It has been steadily decreasing as we're getting out of COVID. And so, I'm not sure. A lot of these forbearances, they're all, most of that whole CARES Act or the whole CARES Act was geared towards government sponsored mortgages. So Fannie and Freddie backed mortgages. So the mortgages we buy don't actually apply to the CARES Act. However, we still want to be conscious of, what the norms are in our industry. And we want to be conscious and compassionate if someone does have an issue. But we've actually seen our most profitable days this year and last year because we have found the opposite of what the mainstream media puts out. And that is people are actually more, they're more inclined to want to keep their mortgage payments going. They're living in their homes more than they've lived in their homes. They're seeing projects around the house.
Right.
They want to do things. So we see more of a connection with people in their homes versus kind of what you see out there about getting forbearances.
Right. Yeah. They're stuck in their house, so they want to make sure they keep it. Yeah.
Yeah.
It makes perfect sense. Well,
yeah. Our income fund is, we have a 96% collectability rate for our income fund, and 90% is the standard. Now, mind you, we're buying these in at a discount into our income fund. So we can withstand, we have a 65% investment to value ratio. Mm-hmm. So we're more conservative than banks that operate at an 80% loan to value percentage. So we can, we can handle someone legally if we have to, but we haven't had to foreclose on anyone. And 96% of our homeowners make payments on time to our company.
That's awesome.
That's better than our rental rate.
Yeah.
Awesome.
So we have a single person. We have like a single asset manager. Their only job is to build relationships and connect with people that are paying, so to ensure that they continue to pay on time.
Yeah, I'm sure that position's well worth the whatever commission or salary base that you're paying them for sure. Well, if we got some people in our audience that are kind of interested in this and want to find out either more about you or where they can, I'm sure they can get your book off of Amazon or any of the other main carriers, but where should we send them so that they could connect with you or find out more about what you guys got going on over there?
Yeah, if I did my job and I scared them, to the degree I needed to scare them, and they're interested in the income fund, you can, and I say that like just jokingly, but if you have any questions, if you have any interest in the income fund, if you have a note question, if you want to tell me I'm wrong, whatever it is, email me at martin@bqfunds.com. And it's martin@bqfunds.com, or they can just visit the website, bqfunds.com. But I'm a pretty down-to-earth guy. I love to help people. So if anyone has any questions, whatsoever, they can email me.
Thank you. That's fabulous.
Awesome. I think there's a lot of information that we got out of here today, and I can't wait to look into note investing. It's something that we flirted with a few times, but never pulled the trigger on because it's a little bit different, and you can only chase so many shiny objects at a time. But the more we learn about it, the more I like the idea. So, Martin, thank you so much for coming on the show today.
Yes,
really appreciate it. I appreciate you finding time for us.
Of course.
Thank you.
You're welcome.
Bye.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.